So Wyckoff wasn't just seeing random wiggles on a chart. He mapped out this repeating cyclical pattern. It's driven by the ebb and flow of demand and supply, right?
Exactly. He basically identified the market's breathing rhythm, as you put it.
And his insights, which are, remarkably relevant even now, they form this Wyckoff market cycle theory.
Yes, outlining four distinct but definitely interconnected phases. They show how trends develop, giving you a structured way to look at what the market's doing.
And these four phases, they're the bedrock of his model. We're talking accumulation, markup, distribution, and markdown. Maybe the best way to grasp these is to imagine, say, a stock, a promising one that's maybe fallen from its peak. How would a walk-off track its journey from that, initial excitement down into a quiet patch and then maybe the next big move? Let's walk through the stages like that.
Perfect approach. Yeah, let's start right at the bottom of our imagined stocks journey. The accumulation phase. So this is that quiet period, the base building that usually comes after a pretty significant downtrend. Imagine our stock has fallen hard. Sentiment is generally fearful, maybe even despairing. But this is where the smart money starts to move.
The institutional players, the big funds.
Precisely. Those informed buyers. They begin to subtly step in because they see value where others just see risk. They're quietly building up their position.
So the price chart might look kind of flat.
Often, yeah. Deceptively stagnant. The stock trades sideways, usually in a relatively tight range. But, and this is key, don't let that calm fool you. Underneath, there's active buying absorbing all the available supply, often from, retail sellers maybe hitting their stop losses out of fear.
So the big players are buying up those stop orders.
They are, and any other shares available. They're essentially clearing the path for a future price rise, getting their large positions set without immediately driving the price up against themselves. Wyckoff even identified specific events here, like a spring.
A spring? What's that?
It's like a sharp, quick dip below the established trading range, almost designed to shake out the last remaining sellers right before the real move-up starts, like a final trap.
Got it. So it looks like it's breaking down, but it snaps back quickly.
Exactly. Or you might see a failure point at the top of the range where it tests resistance but can't quite break through yet, showing demand isn't fully ready.
Okay, so it's this calm before the storm, where the smart money is loading up. But if they're so active, why isn't everyone just piling in and making easy money here? What's the catch for, say, our listener trying to spot this?
That's a really crucial point. It feels unexciting, sometimes even risky, precisely because it happens when fear or just general indifference is widespread. Most people are either too scared to buy after the fall or, frankly, just tired of waiting for something to happen. The real insight isn't just that the big players are buying, it's that this period of, apparent stagnation is vital for the market to sort of reset emotionally, shifting from fear towards neutrality.
So it's risky but potentially rewarding because you're going against the crowd's fear.
Exactly. It feels uncomfortable, which is why many miss it.
Fascinating. Okay, so once that quiet buying, that absorption is complete, and the market's mood has shifted, how does things start to look different? What happens next with our stock?
Well, that leads us straight into the second phase, markup. This is the uptrend everyone loves to see. Once most of that available supply has been soaked up during accumulation, and there just aren't many people left willing to sell at those low prices, demand finally, clearly, overtakes supply.
And that's when the price starts moving up noticeably.
Yes. This is where the action becomes much more obvious. You start seeing that clear pattern on the chart, higher highs and higher lows. Momentum picks up. And typically you'll see volume confirming these upward moves, especially on the up days. That signals strength.
Right. So for traders, the signal is that breakout from the accumulation range we talked about.
That's often the key signal, yes, the start of the trend. And Wyckoff noticed that even within this uptrend, there are pauses, pullbacks. He called them throwbacks.
Like opportunities to get in if you missed the initial breakout.
Exactly. What we'd probably call buy the dip opportunities today, a chance to join the trend. He also identified something called reaccumulation phases within the markup.
Reaccumulation?
Yeah.
So like a mini accumulation during the uptrend.
Sort of. These are specific pauses where the uptrend takes a breather, absorbs a bit more supply that comes out at higher prices, and then acts like a springboard for the next leg up. It confirms the underlying strength.
Okay, makes sense. So our stock has had a good run up. Everyone's feeling pretty good, maybe getting a bit greedy, chasing those gains. But trends don't last forever, right? How do we know when things are starting to top out?
And that brings us neatly to phase 3, distribution, the top formation. This happens at or near the peak of the cycle. And interestingly, it often looks like a mirror image of accumulation, another sideways range, but the intention behind it is completely different.
How so?
Well, here, those same large professional investors who bought low during accumulation start to quietly sell their shares. They're unloading
Unloading onto who?
onto the less informed, the latecomers, people who are now feeling that fear of missing out, FOMO, and are jumping in with enthusiasm near the top.
Ah, so the smart money is selling into that excitement.
Precisely. The price action, again, often trades sideways in a range, but the underlying bias is subtle selling. You might notice volume spiking on down moves this time, or maybe rising volume when the price tries to push higher but fails to break out convincingly. The price ranges might start to narrow. It all hints that supply is being systematically fed back into the market.
So every time it tries to make a new high and fails.
It absorbs a bit more demand until eventually supply starts to win out. A really key detail here is when the stock fails to make new highs altogether. That's often the first major signal that distribution might be underway. It's this methodical transfer of risk.
Okay, another sideways period. But this time it's the pros getting out, not getting in. How do you tell the difference between this quiet distribution and that quiet accumulation phase, especially if they can look kind of similar on a chart?
That really is the million-dollar question for anyone using Wyckoff's ideas. And the key differentiators are context and volume details.
Context meaning where it's happening in the bigger cycle?
Exactly. Is this sideways action happening after a long fall or after a long rise? That's crucial. And then the volume specifics. In accumulation, remember, selling pressure tends to dry up and volume might pick up on the up moves. In distribution, it's the opposite. Buying interest gets exhausted. You might see heavier volume on down moves or on those failed attempts to break higher resistance. It suggests selling pressure is increasing.
Got it. So context and volume details.
Yeah.
And when that selling, that supply finally overwhelms everything, that's the next phase.
That's when we enter the fourth phase, markdown, the downtrend. With supply now clearly dominating demand, our hypothetical stock starts that noticeable sell-off. And this decline can often get fueled by, panic selling.
Or stop log orders getting triggered for people who bought late.
Exactly. That adds fuel to the fire. The price action during markdown shows those consistent lower lows and lower highs, a clear downward path. Volume often surges, sometimes dramatically, when key support levels break, especially the low point of that distribution range we just talked about. That confirms the bearish momentum.
So for trend followers, this might be where they think about shorting.
Or hedging, yes. And Wyckoff also noted redistribution segments here too. Similar to reaccumulation in an uptrend, these are pauses in the downtrend where selling takes a breather but ultimately continues downwards. Sellers are still in control.
And this markdown phase eventually ends.
It does. Eventually, the price finds a new level, a new support zone, where maybe value buyers start seeing opportunity again, and it forms a new broad trading range or base, which signals the potential start of a whole new accumulation phase.
The market cleanses itself, ready for the next cycle.
It's the market's way of resetting, yes, setting the stage for the cycle to begin anew.
This really underlines how important those sideways zones are. Accumulation and distribution, they look kind of neutral, like the market's just catching its breath. But you're saying they're absolutely not quiet zones.
Not quiet at all, far from neutral. In fact, those ranges at the bottom in accumulation and at the top in distribution are precisely where the big hands, the institutional players, are most active. They're quietly taking the other side of the retail crowd's trades. They're buying low when individuals are selling in fear, and they're selling high when individuals are buying in excitement. It's the most strategic part of the cycle.
And volume is the key to seeing their hand.
Volume clues are absolutely critical to understanding the intent behind those sideways moves. In accumulation, for instance, if you see sustained up moves within the range happening on higher volume, that strongly hints at active, deliberate buying by those informed players.
And the opposite for distribution.
Conversely, in distribution, you'll often see down moves happen on higher volume, or those failed rallies we mentioned occur on high volume. That hints at subtle but significant selling by the big investors. Supply is coming back in. It's not just price, it's the effort, the volume behind the price result.
So it really is this constant repeating cycle. Markdown finishes, things bottom out, then accumulation starts again, leads to markup, then distribution at the top, followed by markdown, like the market breathing in and out.
That's a great analogy. Precisely. After markdown, price will eventually find that new support, accumulation rekindles, ready to absorb supply and set the stage for the next markup. It's continuous, dynamic, all driven by that fundamental dance of supply and demand.
Now, beyond just laying out these four phases, Wyckoff also gave us some, well, pretty powerful but simple rules, didn't he? Foundational principles to make sense of the market's apparent randomness. What are those?
Yeah, his studies led to a couple of really critical, timeless rules. The first one is, I think, quite profound. The market and individual securities never behave in the same way twice.
Wait, so history doesn't repeat itself exactly?
Not exactly.
Yeah.
Trends unfold through similar patterns, yes, but they always show variations in size, in detail, and how long they last. Each cycle changes just enough to surprise and confuse people.
So you can't just use a rigid template.
Right. The insight here is to focus on the underlying principles, supply and demand dynamics, and adapt your interpretation, rather than looking for perfect historical repeats. It's like the market is always shape-shifting slightly.
Okay, that's rule one. What's the second one?
The second is equally crucial. The significance of price movements reveals itself only when compared to past price behavior. Basically, context is everything.
Meaning you can't just look at today's price action in a vacuum.
Absolutely not. Doing that can lead you to totally wrong conclusions. You have to compare today's action to yesterday's, last week's, last month's, even last year's. It's about building the market story, understanding the current chapter within the larger narrative.
That makes a lot of sense. So bringing this all together for our listener, how can someone actually use this knowledge, this understanding of cycles and these rules? How does it help make better, maybe less emotional decisions?
Well, simply recognizing which phase a market or a specific stock seems to be in lets you align your strategy. You can be more deliberate. For instance, you might look to accumulate or buy near support during that base building accumulation phase, kind of riding alongside the institutional players.
Yeah.
Or you ride the trend during the markup phase, maybe using stop losses to protect yourself as it moves up.
And at the top.
You might consider taking profits or even think about shorting near that top distribution zone as you see sign supply is starting to take over. It just gives you a strategic framework instead of just reacting to headlines.
It provides a map, essentially. Yeah. Now, Wyckoff also laid out a practical, five-step approach for applying this whole method to trading, didn't he? That sounds really useful. Can you walk us through those steps?
Absolutely. It's a very systematic way to put his observations into practice. Step 1. Establish the overall market's current trend and its most likely future direction. You're looking at the big picture first. Is the whole market generally positioning to move up or down? What's the main tide doing?
Okay, get the lay of the land first. Makes sense.
Yep.
Step 2.
Step 2. Select individual stocks that are moving in harmony with that overall trend. And ideally, you want the ones showing relative strengths during the upswings, or maybe less weakness during downturns compared to the average stock.
Find the leaders or the laggards that fit the market direction. Got it. Step 3.
Step 3. Choose stocks that are clearly showing signs of being under accumulation if you're looking to buy, or in distribution if you're looking to sell. You want the ones where those professional players seem to be actively positioning, as that suggests the stock has the potential to make a significant move that aligns with your objective.
So narrow it down to stocks in the right phase. Okay, so 4 must be about checking your work.
Pretty much. Before you actually commit capital, step 4 is to decide if the stock is truly ready to move. You do this by carefully examining its recent price and volume behavior, comparing it to the overall market again. Make sure the signals really line up and support your thesis.
The final confirmation. And then step 5, I assume, is pulling the trigger. Timing.
Exactly. Step 5 is time your trade to take advantage of the larger market's turns. Generally, you want to initiate buys when the overall market itself seems poised to rally, and initiate sells or shorts when the market looks ready to fall. It's about aligning your specific stock choice with the broader market tide to increase your odds. The real beauty of this whole method is its logical, analytical approach. It helps you make less emotional, better informed choices by focusing on identifying when and where the big players are making their moves.
Wow, what a deep dive that was. We've really unpacked those 4 market cycle phases: accumulation, markup, distribution, and markdown, and explored Richard Wyckoff's, truly timeless insights, from why those sideways ranges matter so much to reading the volume clues and his practical rules. It really drives home that markets maybe aren't just a random walk. There are underlying patterns driven by human behavior and supply demand.
Definitely. And remember, knowledge like this is most valuable when it's actually understood and applied. Wyckoff's work gives you this comprehensive framework professionals still study and use it today to critically look at markets and hopefully improve timing and strategy. It helps cut through the daily noise.
So here's something to think about for you, our listener. The next time you see those headlines, a stock plummeting, or one just stuck going nowhere instead of just reacting, maybe you'll start to look differently. Could you be seeing the quiet, strategic moves of accumulation happening after a fall? Or maybe the subtle signs of distribution playing out near a top, just like Wyckoff observed over a century ago? What patterns might you start to notice now, armed with these insights?